In this session, we are going to see what is analytical procedures. Analytical procedures, as the name itself it says, it's about analyzing information. So when you are a auditor, when you want to do audit and find out material misstatements in the financial statement, you have to identify areas which might contain material misstatements, areas which you may have to focus on. So how you're going to identify what are the critical areas you're going to focus? What are the problematic areas you're going to focus? To identify that, analytical procedures help you. Analytical procedures is where you are analyzing two sets of data. It can be current year information, last year information. It can be budgeted information and actual information. It can be financial information and non-financial information. What you do is you takes two sets of data and you expect a pattern in that data and you analyze and see whether that pattern is there or not there. If that pattern is there, that means if the pattern is there, then you are okay. The expected pattern is there, then you are okay. But if the expected pattern is not there, then there's a problem. You identify that as a suspicious area to do an audit. For example, sales and selling and distribution expenses. Whenever selling and distribution expenses is increasing, sales have to increase. That's what you call expected pattern. So as an auditor, you take monthly sales figures and you take monthly selling and distribution expense and you analyze. Year on year or month on month, selling and distribution expense is increasing, but sales are coming down. Something wrong, which you may have to go and do an audit. It may be a problem with sales. It may be a problem with selling and distribution expenses. You take, on the other hand, if I take one more example from a different perspective, you take purchases. You analyze monthly purchases with monthly sales. To do that, you compute something called gross profit margin. Right? So gross profit margin is your gross profit divided by sales into 100. So gross profit is normally sales minus purchases. So technically you are comparing purchases with sales. Your gross profit margin generally it has to be the same amount, but it is increasing or reducing in an unusual manner. Then you know something is going wrong with that numbers. Then you take that and you analyze in detail. Analytical procedures. For example, number of employees versus the average salary of the employee or the total salaries. You take month on month total salary expense, payroll expense. You take number of employees, total salary divided by number of employees. You take the average salary. Average salary has to be in a particular range. But you see in some month it's going up, some months coming down. That means some anomaly, some unusual thing is happening. You take that and you conduct a special audit on that. That's what you call analytical procedure. So analytical procedure is defined as a process through which an auditor compares two sets of information. He identifies unusual data and then he analyze and he unusual patterns, unusual things we call anomalies, and then he conduct investigation on that is what you call analytical procedure. So before we dive into the theory of analytical procedure, we see how does it practically works. So in order to understand that, let's take financial statements of Apple. So we look at the fourth quarter results. Here we go. We go to consolidated financial statements. So if you're an auditor who is going to start an audit of Apple Incorporation, one of the first thing what you will do is you will get hold of their financial statements. You will look at your financial statements and you will identify, is there anything unusual in this financial statement? So let me see. Let's say I'm supposed to audit this financial statement and provide an opinion, identify areas. So first thing I will go through is this financial statement. So it is comparing quarter ending September 2025 with quarter ending to September 2024. So I have a look at it, like last year 69 million. I'm doing an analytical review. Last year 69 million, this year 73 million. Okay, that's normal. Last year services were 24 million and this year 28 million. Good, they're improving, better. So 12 months ended also, if I can directly compare the 12 months ended, right? So 2942307, it has increased, 9621109 increased, total $391 million or billion dollars or $1 million, yeah. $1 million to $416 million. So it also has increased. Yeah, good. Apple is doing good. Then I look at the cost of sales. What has happened is cost of sales also have increased from 180 to 195. Now, in overall, it looks okay for me, but if I compute the GP margin, right, it may be something unusual might be there. That's what my gut feeling is saying. Because here, 3912,416, it's roughly, it may be okay. It may be okay. I don't think a problem. But I'll quickly do a ratio analysis and see whether is there anything unusual in these numbers. So let me open my numbers. And here, first month, it says, hello, can you get up? This is numbers. Come. Open a new document. Blank document should be fine with me. Settling. All right, here we go. So the total net sales are 416,161,39. Let's see if I can copy and paste directly. So we have the total sales number. No, can't copy and paste like this, I think. So I'm going to take the number separately. No, come on, C. Come on. No, it's not. Okay, good. So command X and command V. So that's their sales number, and their purchase or the cost of sales number we put next, which is 195 and 198. So I put it here. Right, so again, I cut it from here, this guy out here. Right, then I find out my GP, so gross profit. Oh, that's the gross profit, no? Yeah, that's a gross profit. So it's given, so I compute the percentages to understand. So GP of Apple this year is into 100. It is 46%. Previous year it was Last year also it's 46%. This year also it is 46%. So it looks it's so good. Like it's so good for me. Like so, there's nothing for me to do a additional audit on this. It looks okay for me in my analytical review. Let's say if it has happened like this, right? Last year it was 25% GP margin, and this year it is 46% GP margin. Then it becomes a problem. As auditor, it becomes a problem for me, right? So this is what you call analytical review. So let me continue my search. Last year research and development expenditure 31, this year 34, sounds okay. 26 to 27, selling and distribution, selling and general and administrative expenditure, that sounds okay. Operating income last year 123, this year 133, perfect. Other income 269, that's too small. See, when I'm doing analytical review, other income, I don't want to bother. I know there's an anomaly, but I don't want to bother too much about it because it's a very too small, tiny amount, right? And forget about it. Income before provision, net profit. So overall, when I look at Apple's P&L, it looks good. There's no anomalies. There's no unusual things coming out. Then I look at the balance sheet. I mean, you can do analytical review. Like if you do the analytical review on the P&L level, we call it as a preliminary analytical review. But if you go and do analytical review at the ground level, like individual items, we call it as substantive analytical. So we have net sales categories. So of course, iPhone is giving them a lot of money, followed by Mac, iPad, still in the market, right? I mean, good. Wearables, home accessories are now giving more money for them. Their services are giving huge amount of money. So good. Everything looks fine. Then I can do the same analytical review on the balance sheet as well. So when I'm doing we have to understand the difference between a P&L and a balance sheet. P&L is a summary of transactions for the whole year. On the other hand, the balance sheet is a picture at the year end. So this is the picture at the year end, or September 27th. In the picture, we can see anomalies. The problem is when you do the balance sheet analysis, you can't just compare last year number and this year number. Rather, sometimes you may have to compare with the P&L also. That's why we use ratios. Not for everything, but for some items. Cash and cash equivalents, last year $29,000, this year $35,000, sounds okay for me. Marketable securities, 35 and 18, sounds okay for me. Account receivable, last year 33, this year 39. That does not look okay for me. I mean, I don't know. It's too difficult to say whether it's okay or not okay, so I have to do a small ratio calculation. So what I do is I go here, I compute something called debtors collection period. How do you compute debtors collection period? Debtors collection period is computed as like this. You take ideally, you take total credit sales, sorry, you take this down. You take what do you call average debtors. And you multiply that by 365. You will find out what do you call it? When you divide average debtors divided by total credit sales into 365, that will give you debtors collection period. So I can find that out. Now here, my average debtors number is how much for the last 2 years? It is 39 and 33,410. So I put that here. What is debtors? No. Okay, that's the other thing. If the average, whatever, if the average debtors are not there, we can take the year-end debtors. So I take both year-end debtors, $39,000 and $33,000. So here I will put total credit sales. If the credit sales is not there, I can put the real sales. So I put the real sales here. That's it. And then I calculate, I compute the debtors collection period. So hope you guys remember the formula now. So I take $39,000 divided by total credit sales multiplied by 365, which gives me 34 days. So on average, or 35 days, on average, Apple's debtors take 35 days to make the payment. So how that it is compared with the last year, 31 days. That seems to be a small problem. Last year, Apple was able to collect all the money from their customers within 31 days. But this year, it's taking 34 days, right? So that seems to be a problem. So something wrong with their debtors. So the next step is talking to the credit controller, talking to the manager who is in charge of debts or credits, asking, hey guys, what happened? Like, why you guys are taking more time for you to recover money from Apple, from your customers? So if we continue like that, vendor non-trade receivables are there. Non-trade receivables, vendor non-trade. So the non-trade vendors, from them also Apple has to take some money. Sometimes non-trades maybe, I don't know, from some government authorities or something, they may have to receive some money. Inventory. That sounds very interesting. Look at inventory, what has happened. Last year it was $7,000. It has become $5,000 this year. That is quite unusual, right? So that we have to analyze and see. 5718 and 7286. So I put the inventory numbers here. Inventory 5718 and 7286. 7286. Here I compute something called inventory resident period. So inventory resident period is generally calculated by average stock divided by cost of sales into 365. So 365. So let me do the calculation here. So average stock is how much? Average stock is this much. So inventory is here. I can put it back the fellow here, come here. You come here, right. Cost of sales I can take from here. Oh, that's not cost of sales. No, that is the GP margin, isn't it? That's a gross profit. So I can take the cost of sales very easily by like this equal this minus this. Here, say, yeah, cost of sales exactly 100,000. So Riyasha, you hope you understand this is GP. They didn't give, I took GP numbers earlier. That's why I'm computing the cost of sales. So sales minus GP is equal to cost of sales. So here is the cost of sales, here is the cost of sales. I think this number would affect it. No, I don't think this is the right number.
You customize that number.
Yeah. Yeah. So here total cost of sales, 2221 is the right number. Okay, so now I compute the inventory resident period. So it is equal to days divided by this multiplied by 3665. So which comes to normal, they keep an inventory. This year they have kept the inventory for 9 days roughly. Last year it was 14 days. So last year it took them 14 days to sell the stock. But this year it is taking them only what you call 9 days to sell the stock. So it looks good. It's looked great, right? But that's a terrific achievement. I mean, inventory resident period, you are reducing from 15 days to 10 days or something, right? Here, from 14 days to 9 days or 15 days to 9 days. It's a terrific achievement. But as an auditor, I am skeptical. How it's possible? What did they do, right? So I have to audit their stock properly. I have to audit their cost of sales properly to find out why this anomaly has been created. Of course, there can be reasons for that. There can be a reason for these anomalies, right? It's possible. There can be a reason for these anomalies, or sometimes there may be no reasons for this anomaly. If there's no reasons for this anomaly, then as auditor, I have to verify, I have to audit that in a proper manner. So this is what you call analytical procedures, right? You take two sets of numbers, which can be financial, like what we have done, or which can be non-financials, right? So we check whether these numbers are complying with a particular pattern. And if these numbers are not complying with a particular pattern, we conduct additional investigation into this. That's what we call analytical procedures. So now let's go and start the work on our handout.